So this is another thing that seems like a pretty simple idea. As Warren Buffett and Charlie Munger says, they take a simple idea and they take it seriously. We know that we are, or at least it's been said that we are the sum of the five people we spend the most time with. Most people are bad with money because they never learned about it. And if they spend a lot of time around people that also haven't learned that much about finance and never became really good with money, you're going to pick up their habits and their attitudes. And there's a lot of attitudes and habits, especially in, we'll say America, because that's where I'm from. That's where a lot of our statistics are from. But this is certainly a worldwide thing. I actually live abroad in Asia, and I see people's attitudes about money from all different cultures, and I can say with certainty it's pretty much the same everywhere. Everyone's facing the same challenges and have the same cognitive biases that make us bad with money. So when you spend a lot of time around most people that never learned how to be good with money, you pick up a lot of bad habits and attitudes. One of the attitudes is that something we already covered, right? That if you want to be wealthy or if you want to make money, that's greedy or it's somehow immoral. Of course, if you're breaking laws, if you're hurting people, if you're doing things that are immoral, that can be the case. But actually, if you've got a family and you've got dreams, you've got things that you want to do with your life, in the world in which we live in, which is basically a capitalist world now, I mean, globally, everywhere is capitalist. I mean, I actually live in Vietnam, which is a communist country, but it's actually in some ways the market is more free than back home. There are far, far fewer regulations on what businesses can do, believe it or not. And so pretty much everyone in the world now is capitalist. I mean, money is just a fact of life. And to deny that is to simply deny reality. That's the way the world is. That's the world that we are living in, that we've been born into. Okay, so spending your time around people that are good with money or have good attitudes about money, about building wealth, not greedy, arrogant people, some, people, you see on TV, this sort of archetype of like the aggressive, ambitious businessman who is like really mean and takes advantage of people. That's television. That's an avatar. That's not necessarily reality. What you'll learn if you become friends with a lot of wealthy people, especially people that made their wealth by themselves, self-made people, is that oftentimes they're some of the most generous people. They give a lot of money to charity. They simply understand the nature of building wealth. And the nature of building wealth oftentimes is psychological, which is, of course, what this course is all about. So choosing who you spend your time around. It means not spending time around negative people. It means trying to become friends with people who are educated about money, about finances, about business. Maybe they're entrepreneurial. I mean, I personally have had to cut out a lot of friends in my life, not simply because they're not good with money, but just negative people, people that tend to whine or gripe or have a victim mentality. Those people will hurt you. Because if you take on those attributes, you tend to kind of become the same way. You start to blame other people for your lack of success or happiness. You start to whine and fall into self-pity and things like that. So this is a really important thing that seems like it's indirectly related to money, but just to be a happy person, to be a successful person in general, you really need to choose carefully who to associate with. And in many cases, that will mean not being friends with some people that hold you back. I mean, you have to set your priorities. You have to make a choice. If it's important for you to be better with your finances, to be better with money, to become financially independent, then who you choose to spend your time with is very, very important. So it means stop being friends and spending time with people who think that money is evil or that money is hard to earn, because it doesn't have to be. Or that rich people are evil, or that rich people are greedy, or that wanting to make more money makes you greedy. The stock market is gambling. All investing is risky. None of these things are true. Of course, we all know examples of some people who are greedy, some rich people who are greedy. We all know examples of, ways of investing in the stock market that is gambling, as we've already talked about earlier in the course. There's examples, individual cases of all of these things. But does that mean that we can generalize and say that money is evil or that rich people are greedy? Those are overgeneralizations. I mean, there's lots of poor people that are evil and poor people that are greedy as well. Basically, money is neutral. It can be used for good. It can be used for bad. Most of us need at least a certain amount of it, so it's neutral. And understanding that at that fundamental level will help you have a better emotional connection to money. And if you integrate sort of all of these ideas that I'm talking about in this course, in general, your finances will start to improve. You start to feel better about money. You start to feel better about your finances. You combine them all together, and your life will start to change. At least your life as it relates to your finances, which is of course related to everything else in your life these days as we live in a free market capitalist society. So I want you guys to think about that, and I think it's a really important thing. Warren Buffett says that risk is not knowing what you're doing. There's all kinds of financial theories about risk. A lot of the business schools teach that risk is volatility. So when volatility is high, meaning let's say we're talking about the stock market, prices are going up and down and fluctuating a lot, it seems risky. In the short term, that's true, because if you're trying to buy and sell stocks, which are just ownership pieces of businesses, right? You're trying to buy and sell every day or every month or even every year, you might lose money that way. That's risky. But if you're talking about holding assets over long periods of time, assets that produce cash, assets that are producing value, then really it's not risky. Risk is not doing what you're doing and doing something stupid. Okay, so you need to spend your time around people, or maybe cultivate new friendships and associations with people that understand these things. It's no coincidence, as I've said before, that professional investors, at least the best professional investors, can consistently outperform the stock market, or at least get adequate returns from their investments. And it goes back to being conservative and careful about your investments. A lot of it is not about trying to get great results. It's about avoiding bad results, avoiding losing money, avoiding making mistakes. Even by simply buying something like utility companies that pay high dividends and are protected by the government. They're regulated, so because we're utilities, electricity, water companies, we need those services. Those are not sexy investments. They're conservative investments. You can pretty much count on at least 5 to 8% if you can include the dividend and a little bit of appreciation every year. That would be considered an adequate return, taking on very little risk. Now, that may not get you rich fast, but over time, you're almost virtually guaranteed to become financially independent if you can invest consistently. My grandma actually did this very thing. She was a teacher. She was a retired teacher, and she had just been buying a utility stock. It was just one company, because her father, which is my great grandpa, he had been an employee for a company called Washington Water Power. It's now called Avista in the United States, and they're a typical utility. They serve the Northwest, and they usually have a pretty good dividend. It varies, but anywhere from 3% to 5%, depending on what's going on in the economy and such. And over time, that made her financially independent. She just held on to that stock and added to it, reinvested all the dividends, and it's a very, very simple thing to do. Of course, professional investors will tell you that's overly simplistic, and you should pay them for their services because they can make you a lot more money. But basically, if you understand these basic fundamentals of finance, and you just do these simple things and avoid making any big mistakes by trying to push your capital too hard, you're going to end up doing really well. Most people don't do these very basic, simple things. It's almost hard to believe how easy it is. It takes patience, it takes discipline, but it doesn't take anything fancy. Warren Buffett has famously avoided investing in the technology sector because it's outside of circle of competence. I mean, until his recent investment in Apple, which he actually considers to be a consumer goods company that he can analyze and understand, rather than a tech company. So another simple idea here is that Warren Buffett, he invests in things that he understands. So my grandma understood utilities, right? I have certain ways that I invest that I think in companies that I understand. I mean, if you understand finance and banking, you might want to invest in that sector because you can analyze those businesses. If you understand retail and consumer goods, and analyze and invest in those businesses. You want to stay within your circle of competence, as he says. So it's another important idea here when it comes to lowering your risk when you are investing. Most people don't do that. Most people, watch personalities on TV like Jim Cramer, or they read articles and then they just sort of follow that advice. But that doesn't work because you will get contradictory advice from every single person writing an article and every single so-called professional talking head on TV. The best thing to do is to be a contrarian and to think for yourself. But in general, you want to have the attitude that investing is something that can be learned, that it's not something that is mystical or complicated. It's simply a matter of lowering your risks and behaving in a way that is rational. Behavioral finance is all about behaving in ways that are rational and cutting out all kinds of stuff that make us emotionally make mistakes about money, fearing loss, being greedy, taking on bad attitudes that others have, keeping up with the Joneses, and understanding that risk is not volatility. Risk is not investing in the stock market or real estate just automatically being risky. Risk is not knowing what you are doing. And by choosing to invest in vehicles that you understand, you are lowering your risk. For example, if you understand real estate well, then you should probably be investing in real estate. You'll know when it's a good time to buy. You'll know about that market. You can analyze the value of properties. If you understand how to analyze businesses, you should invest in the stock market and choose sectors that you understand. If you understand neither of those things, and you also have no interest in the stock market or real estate, then you should do what Warren Buffett suggests, which is simply invest in an index fund of something like the S&P 500 or the Vanguard 500 or the Wilshire 5000. There's all these different indexes. You could even just invest in the Dow, which is just 30 of the biggest blue chip companies in the world. Just invest in those, and over time, history tells us you will get roughly, give or take a point or two, a 9% on your money. Compounded, that's going to get the job done for you. The thing that most people don't do is that we don't have the patience to simply do that. It almost seems too simple. It almost seems too easy. And also, the nature of the stock market, as we learned from the Mr. Market lecture, makes it hard to take the ups and downs and things like that. So just keep in mind the difference between investing and speculating. There are two totally different things. Buying an asset and just hoping that it goes up, or trying to time the market and thinking it's going to go up, or listening to some talking head on TV or reading some article where they say there's a prediction about what the market's going to do, that is speculating. It's the same thing as going to the casino and playing a slot machine. Investing is totally different. It's about valuing an asset based on true intrinsic value, and being careful who you associate with, who you listen to, who you talk to about finances will help you a great deal over time when it comes to building wealth and in general being good with money. And so I want to stay on this idea of investing versus speculating, because it's such an important thing to understand. We need to get it out of your head that investing is risky or that it's gambling. Nothing could be further from the truth. It's all about understanding what you are. This idea seems like an indirect way to solve the problem of investing or being good with money, but the importance of finding the right work cannot really be overstated. And Warren Buffett talks about this a lot. If you do what you love, or at least do something that you like or that you're good at, then you're going to enjoy it more, and you don't feel like you're working. Psychologists call this a state of flow. When you're doing this work, you kind of lose track of time. You get into a state of flow, and when this happens, if you're doing work that you like, there's no longer a real huge rush to get wealthy, because there's no rush to retire, right? Most of us want to retire because we only want to work as long as we have to so that we can have financial freedom. But the reason is, for most people, is because we don't like what we do. I mean, a recent study showed in America that over 80% of people don't like their jobs. 80% is a pretty big majority to have people not like what they do every day. So of course, there's a rush to save money and get wealthier. There's a rush to retire. But if you do what you love, there's no rush to retire. I mean, again, Warren Buffett, Charlie Munger, they're 87 and 94 at the time of this course, and they are still going strong because they do what they love. You can take your time building wealth and slowly accumulate appreciating assets over time in a very safe way. You don't need to try to get rich quick. Of course, it's hard to not want to get rich quick if you hate what you do every day. You want to compile money as fast as possible so you can get out of that job you hate, or so that you can retire. But the problem, as we now know from stuff that we've already covered a little bit in this course, is that you can't force your money to get higher returns just by taking on more risk. You end up losing money. It ends up being more stressful. And as Warren Buffett says, you can't get a woman or excuse me, you can't produce a baby in 1 month by getting 9 women pregnant. Some things just take time. Investing is one of those things that just takes time. Now, you can get more skilled at it, like Warren Buffett and other professional investors, and you can increase your returns. You can get wealthy faster, but there's still going to be a limit to that. I mean, Warren Buffett, over the last 50 years, one of the greatest investors in history, he's averaged a 20% return. So that's pretty much the maximum you can get over the long term. Now, the reason his returns are actually as low as they would actually be higher because he's working with huge amounts of capital now, and the larger your money gets, you run into the law of large numbers. It's harder to get higher return. When he was younger, he was actually getting 30, 40, even 50% compound returns in his career. But obviously Warren Buffett is in the top 1% of wealth. But the point here is, if you find the right work to do, it really doesn't matter that much how much money you make, because there's no rush to retire, and this will have a very positive impact, sort of paradoxically, on your finances. You don't need to be in a rush. You save some money, you invest it over time, you get wealthier, and it's a stress-free way to build wealth. And also, it's important to understand, even Warren Buffett didn't become a millionaire until he was in his mid-30s, and he'd been investing since he was 11 years old, and he'd been saving his money since he was a kid. And he was around 25. He had about $100,000 when he finished his master's degree at the University of Nebraska. He also studied at Columbia under Benjamin Graham. That was his mentor, who I already mentioned. He's considered the father of value investing. But even Warren Buffett, the great man, the brilliant investor, didn't become a millionaire until he was in his 30s, and he made 99% of his wealth after the age of 50. That has to do with the nature of compounding and how you get exponential returns. So over time, as your capital grows, as long as you don't do anything stupid and lose money, it will accelerate, right? I mean, it's pretty obvious if you know anything at all about compound interest. If you make 10% on $100,000, that's $10,000. If you make 10% on $1 million, that's $100,000. You're going to start getting rich really fast once you get up into the millions, even the hundreds of thousands. Once you hit, let's say, $300,000 or $400,000 in savings, and you have a 10 or 20% year, you're talking about tens of thousands of dollars that you make passively. The hard part is getting started. The hard part is letting your capital start to accumulate at the very beginning, which of course is why most people can't do it. It goes back to delayed gratification, which we already discussed. But the point is, if you find work that you like to do, you can afford to be patient. And by affording to be patient, you can afford to be conservative and not push your capital too hard. Be happy with an adequate return, whether that adequate return is 6 or 7%, or hopefully something more like in the double digits, 11 or 12%. That will make you wealthy over time. And you can almost guarantee to get those type of results if you're just patient, right? It's a classic tortoise and the hare story. Slow and steady wins the race. And as cliche as that sounds, as pedestrian as that sounds, I mean, it's not sexy. In the world of investing, in the world of finance, this is the way to go. This is what the greatest investors have to tell us. And the tricky thing is, for a lot of us psychologically, right, this is of course about behavioral finance, is that we see people win the lottery, or we see people get rich off of buying that sexy IPO, or buying, Bitcoin when it was new, and becoming instant millionaires. But for every one of those instant millionaires, you have millions and millions of people, that's us, right, that have to do it the old-fashioned way, which is simply saving and investing. And if you have this idea of getting rich quick, or this dream of this one big investment, what research shows us, what history shows us, is that the odds are greatly against you. What you're going to end up doing is getting the opposite result of what you wanted. You're going to end up losing money because you become a speculator, you become a gambler. Patience is pretty much a requirement for anyone that wants to guarantee that they become financially dependent, not just hope, not just want to get lucky, not win the lottery. If you are just patient, you compound your money over time, you will get wealthy. But it's actually not what most people do. Most people find it difficult to be patient. So finding the right work that you enjoy getting up every day and doing, even if it only pays you enough to save, let's say, a few $100s a month, that's still better than doing a job that you hate and then trying to rush to retire. You'll not enjoy your career. You might end up pushing your capital too hard and losing money, and also not being as healthy, as happy, and all these other sort of side costs that happen. So this is sort of a paradoxical thing, but you will increase the odds of becoming financially independent even if you make less money by doing work that you enjoy. It's a really important thing to understand. So I hope you guys pause, think about that, and if you're not doing work that you enjoy, maybe you need to reevaluate whether or not it's worth it for you. And in the long run, it almost certainly is to do that work which you know it would be more suitable than what you're doing now, even if that means going back to school or something like that. Now, in the next lesson, we're going to look at this idea of being careful who you associate with. This ends up having a really big impact, actually, on your wealth and on your ability to build wealth over time, according to behavioral finance. Charlie Munger has said, the desire to get rich quick is pretty dangerous. And the reason that's true is because it forces us to try to push our assets to rates of return that are impossible, basically, that are unrealistic. We want a shortcut. We want to get rich fast. And of course, there's lots of reasons for this, but basically it comes down to us just being greedy. We don't want to have to wait. We want things fast. That's just the way the world is now, and maybe it's the way it's always been. All scams and con artists are able to exist due to the large number of greedy people in the world. I mean, if something sounds too good to be true, it probably is. And the only reason that con artists are able to succeed in conning people is because they paint a picture of easy money, something that can't be true, and they're really, really good at doing that. Greedy people say, okay, let's go ahead and invest the money, and then they end up losing it all. And another thing, another way to put this, as Warren Buffett has said, some things just take time. You can't produce a baby in 1 month by getting 9 women pregnant. It's a pretty interesting example. But he's saying, it takes 9 months to make a baby. Okay, you can't change that. The same thing is true with investing, because when you buy an asset based on the cash flows of a company or of a real estate property, you have to wait for that profit to come in. It is a natural cycle. And that's why Warren Buffett, he also criticizes like quarterly and yearly earnings reports. It's pretty arbitrary to think about the fact that in 1 year, a company should make a certain amount of money, or we should be judging a company based on its 1 year performance. A lot of things that are happening in businesses, they take a long time. We're talking about developing products and taking time to develop those markets and to sell those products and to grow the market and to get customers. All these things take time. That's why he looks at 5-year or 10-year cycles. When you invest, you have to give your investment time to grow, and there's a natural growth that will take place. It's just like when you plant a seed, you have to wait for that seed to turn into a little plant and to grow into a mighty oak, right? You can't shortcut that process of turning that seed into a tree. There are no shortcuts to wealth. So just get it out of your head. Trying to win the lottery or trying to go to the casino, you're going to lose money. It's a net negative value activity. That's why casinos make money. The cards are literally stacked in their favor. But that's okay, because if you learn, just enjoy the process, to just wait to earn money and to invest it wisely and let it compound, you're virtually guaranteed to become financially independent over time. Just don't be greedy and don't be impatient, and you will get there. Understanding money and investing and just being disciplined will get you there over time. It's pretty much a guarantee. Just don't, freak out and do anything stupid. You have to stay the course. The odds of winning the Powerball lottery jackpot in the United States are 175 million to 1. So despite the fact that you've seen people win on TV, because of course they always announce it because they're trying to sell lottery tickets, because they're trying to make money from the taxes, right? When you win, hundreds of millions of dollars in the jackpot, you pay a huge chunk of that in taxes to the government, okay? They want you to think that you have the chance to win, but in fact you don't. You would be far better off investing money that you would have used for lottery tickets to simply buy assets, appreciating assets, whether that's real estate for you, whether it's gold, or whether it's stocks. That's where you should be putting your money. Now, things that produce cash are far better, and we're going to talk about that more later in the course. So actually, gold is not the best place to put your money for this reason. At least it's an asset that has value. It's better than buying lottery tickets, okay? So that's why we're going to look next at the importance of finding the right work to do because this helps you to not be impatient. If you don't feel like what you do every day is a slog and it's really hard to make money, you're not going to be in a huge rush to get rich and to get out of that work. This is a very helpful factor in being able to be patient as your wealth builds. Again, to talk about gold, Warren Buffett says he'll accept gold as a gift, but he'll never buy it because it doesn't produce cash. Therefore, its value is based entirely on what people are willing to pay for it. We hope that people will always be willing to pay for gold. And so gold probably will always hold some value. If the stock market crashes or the real estate market crashes, usually that makes gold go up. That's why people consider gold to be a hedge, and everyone should own some of it. Warren Buffett doesn't own any gold. Because the stock market has outperformed gold by an extraordinary degree over the long term. To give you an example, $10,000 invested in gold in 1942 would only be worth about $400,000 today, while that same investment of $10,000 in just an S&P 500 index fund would be worth $51 million. Now, that may be hard to believe, but you can run the numbers yourself. That's the nature of long-term compound interest. When you compound your money at 9 or 10% over, in this case, about over 70 years, right? I guess almost 80 years now, you get astronomical figures. Now, obviously, none of us are going to be able to wait 70 or 80 years for our money to compound, but most of us can wait 20 or 30 years for our money to compound, and it will go up into the millions if you can just wait, be patient, and ignore the ups and the downs. And remember, over this time period that we're looking at here, we had World War II, right? 1942 was in the middle of World War II. We had the Vietnam War. We had a huge market crash in 1987. We actually had a big recession also in the 1970s. We had the dot-com bubble burst in 2000. And of course, we had the Great Recession in 2008 and 2009. If you had just left your money in an index fund throughout all those ups and downs, it would continue to compound. Whereas gold just goes up in value slightly. I mean, it's barely outpacing inflation. Sometimes gold will go up a lot in 1 or 2 years, and if you're lucky enough to time that and triple your money in a couple of years, well, good for you. But that would be luck. That wouldn't be investing. That would just be lucky timing of the market. Okay, so it's important for you to understand the reason that the S&P 500 compounded so well is because it is composed of 500 of the strongest businesses in America that produce cash. And the way that these indexes work is that companies that are shrinking or not doing well, they get dropped out of the index, and new up-and-coming companies get put into the index. So the index is always changing. What companies are included are changing, and so it's like a self-cleansing system, so to speak, where it's only the best companies, the most profitable companies, that are part of these top indexes, and they make cash. Stocks and real estate as well produce cash that can be reinvested for compound returns, and that's the main idea. So a lot of people like to buy stocks that have dividends, and if you reinvest those dividends, it's another very conservative way to invest. You just keep your money compounding. You don't touch the principal. An outstanding company will produce ever increasing returns that can turbocharge the rate of compounding, and it gives you ever larger exponential growth, ever increasing returns. We want exponential growth, and that's the reason why 8 or 9% compounding will make you rich over time. It's simple, but it's not easy because of the emotional challenge of watching your money fluctuate. Okay? If an asset does not produce cash, it's risky because it cannot be objectively valued. I mean, if you look at gold and you say, how much should an ounce of gold be worth? The only thing that we can base it on is what prices have done in the past. We can look at the charts about the value of gold, but gold doesn't produce anything. There might be more demand for gold because it's being used for more jewelry, or it's being used as a component in some technology. So maybe if we can predict that there's going to be increased demand for gold, we can speculate that it's going to go up. but that's the best we can do. When you look at a private company and you see that it produces a certain amount of money consistently, we can come up with a real accurate value for that business. Here's a simple example if you don't know anything about valuing businesses. If you have a private company that earns on average about $100,000 per year, it can be conservatively valued at about $500,000, depending on lots of other factors, of course. There's other things that go into the valuation besides just the earnings, such as the competition, the changing nature of the industry and the market, and things like that, how much debt they have, things like that. But usually we look at a private company, and 5 times 1 year's earnings is kind of a benchmark. It's a typical sort of a figure that we'll look at. So you can look at a business and say, okay, this business produces consistent $100,000 profits. We're talking about profits, not revenues. After all the expenses are taken out, we can say that a reasonable person would pay something like $500,000 for that business. It's worth 5 times its earnings. In the stock market, of course, the earnings multiple is usually 10 times or 15 times or more because of the liquidity of the stock market, because of the quality of the companies. The reason that they're even listed on the stock market originally is because they've been very successful in the past. So the earnings multiples that you'll pay for publicly listed companies in the stock market are usually much higher. Of course, right now in 2018, the multiples are even higher because interest rates are still very low. Interest rates have been going up, but when interest rates are low, the stock market is going to be higher because there's not very many places to invest your money. The demand for stocks, therefore, is much higher, and so the earnings multiples for companies that people are paying for is higher. As interest rates go up, then stock market will have pressure to go down because the alternatives that people have where they can put their money in T-bills or bonds, the interest rates will be higher, and so a lot of people will choose to allocate their capital there. That's kind of a whole nother topic. But basically, the point that I'm making here is that a cash producing asset like a business or like a real estate property, you can value that. Whereas a Bitcoin or gold or silver or even commodities like coffee or orange juice or oil, it's very difficult to put a value on that because those markets fluctuate based on supply and demand alone. Whereas businesses are valued not based on just the supply and demand, but it's based on how profitable that business is. This is a very, very important idea to understand. Understanding this, we can conservatively buy companies that produce consistent cash flows and know that over time, our investment will produce an adequate return. It's basically a guarantee. Okay, so knowing that, you can learn how to analyze businesses and be a good investor. If you don't want to have to do any of that, buy the index fund. When it comes to commodities like gold, there's no way to objectively value it. And I want you guys to understand this concept. This goes to the heart of understanding behavioral finance, understanding the rational, way that investors, smart investors, think about assets and how to allocate their capital towards assets that will appreciate in value. Okay, and so in the next lesson, we're going to wrap it all up and kind of review the most important ideas of the course. So I want to be a little bit repetitive here when it comes to this idea of investing versus speculating because it's so important. And most people don't seem to understand this idea. Speculating is buying an asset and simply hoping that it will go up in price. It's gambling. You're just hoping, you're guessing, not based on anything concrete. Okay, investing, on the other hand, requires a thorough analysis of an asset and its current price, and then only buying that asset when there is an obviously high probability of achieving an adequate return. An adequate return is whatever you feel will get the job done for you. That might be 5% compounded, that might be 10% compounded, that might even be more. An adequate return means that your money will compound at a rate that will help you achieve your financial goals. As we know, simply investing in an index fund will get you 8 or 9% over time. That's a pretty good return, and we definitely could say that's an adequate return. So if you did nothing but buy index funds that have very little fees and simply dollar cost average it into them, which means invest the same amount of money every month, just sock it away into the index fund over time, you will become a millionaire in 20 or 30 years. Anybody, literally anybody that can save a couple $100 a month can do it. That's investing. If you want to get an even better result, learn how to analyze businesses, look at their balance sheets and their income and their assets and their debt, and then look at the price of that stock. If you get good at doing that, then you can increase your returns even more without taking on more risk. There's this dangerous thing that is taught in business schools, and even that you see on TV, that volatility equals risk. And then in order to get a higher return, you have to take more risk. But if that were true, that would mean you'd actually be increasing your odds of losing money. I mean, that's very paradoxical. In order to make more money, you have to take on more risk. So that means maybe you're going to lose money. So that's just gambling, right? That would just be gambling. Why is it that Warren Buffett can make money consistently? It's not because he's lucky or because he's taking on more risk. It's because he knows what he's doing. It's because he's a know-something investor, because he's knowledgeable. If you're not knowledgeable, you buy an index fund. If you are knowledgeable, you lower your risk by analyzing businesses. It's as simple as that. It doesn't go any further than that. So make sure that what you're doing when you invest your money, whether you put it into gold or whether you put it into real estate or whether you put it into the stock market or anything else, that what you are doing is investing conservatively and not speculating. And again, I will just mention that since gold and other precious metals, they do have some value because there's a market for them and people hold them as a hedge. People ascribe value to them. They are non-cash producing assets. So gold will never appreciate in the long run as much as a well-run company that produces profits, growing profits over time. So that's why people like Warren Buffett, they far prefer owning businesses, i.e. stocks, as opposed to owning gold or other metals. Warren Buffett says he will take gold as a gift, but he would never buy it. So just something to think about. A lot of people really believe in gold because they think it's a concrete asset, whereas the dollar or the stock market often crashes. The price for gold crashes as well. I mean, it fluctuates a lot as well. But some people think that owning these hard metals is something concrete because it's a physical thing that you can own. The problem is that thinking is flawed because they don't produce cash that can be reinvested for compound returns. Businesses produce cash, and even a business that doesn't produce an ever-growing amount of sales and profits, as long as it produces a consistent profit, those profits can be reinvested for growth. So for example, Warren Buffett famously bought a company that he loves called See's Candies in the 1970s. He paid like $25 million for it. And right now it's a very small portion of Berkshire Hathaway. It's a small company, relatively speaking, but he constantly uses it as an example because even though See's is not growing its profits and earnings much over time, it's so profitable in terms of having high margins and being really consistent. They're able to take those profits and then reinvest them into other businesses that have higher returns. And that's basically what we are trying to do, right? You just have, let's say we have a regular job, and let's say you can save $500 or $1,000 a month. You're taking your surplus from your job and then you're investing it into businesses that will grow your capital based on how well that business is doing, that you'll get an adequate return. Buying gold is kind of like gambling because even though gold tends to historically hold its value and go up slowly, it doesn't produce cash. So I just want to make sure that I mention that to you guys. So simple rules. If you don't understand an asset, don't buy it. You should only buy an asset that you can understand and analyze. Basically, look at how much cash it's going to produce and being able to predict to some degree what it's going to be producing in the future. This is why Warren Buffett likes simple companies like Coca-Cola, like Gillette, and certain banks. He can pretty much guarantee people are going to still be drinking Coca-Cola in 10 years or 20 years. He can pretty much guarantee that men are going to be shaving in 10 years and 20 years. And especially with a product like Gillette, where they sell the razor blades which wear out. You have to continue to buy the razor blades. It's a very, very good model for repeat cash flow. Also, why he likes insurance. Everyone has to have car insurance, medical insurance, and all different kinds of insurance. It's a good business because it's consistent, and he takes the money from those businesses and then he reinvests it in other consistent businesses. Very simple. People often overlook how simple what Warren Buffett does is, but by continually doing stuff that he understands that is simple and that he can analyze, he gets above average returns. And it doesn't have to be super complicated, but it does have to be something that you can be disciplined about and be patient enough to wait for those returns to come in. You don't even have to accurately value an asset. It says if you cannot accurately value an asset, don't buy it. But if you buy an asset at a cheap enough price, it can be a conservative investment. And if you can't come up with any kind of a accurate value, you really just have no idea what the value is because the business results fluctuate so much or because it doesn't turn a profit at all, simply don't buy it, right? You don't have to swing at every pitch, as Warren Buffett says. That's why they like investing. They wait for a fat pitch. They wait until they see an obviously good investment, something that's undervalued, and then they buy as much of it as they can. They put the bulk of their assets into this obviously good investment. It's the opposite of diversification, which we discussed a little bit previously. If prices of a valuable asset are near historic lows, it's probably safe, right? I mean, if the stock market crashes and the stock for, let's use Coca-Cola as an example, goes down by 30 or 40% from what was already a reasonable price, then you know that it's probably safe to buy that asset and your odds of making money are really, really good. On the other hand, if prices of a valuable asset are near historic highs, it probably isn't safe because you have more downside than upside. Investing is all about probabilities. So when you buy when markets are low, it's the best time to buy. You have more upside. When you buy when markets are high, it's the worst time to buy. You have more downside. So it's really as simple as that. The problem is sometimes you have to wait a long time for markets to go down before you can get a really good deal. And sometimes you have to wait a long time for markets to go up so your money can appreciate. So patience in investing is a critical attribute that you have to have. And if you're not patient, again, the simple thing to do is to buy index funds and then just forget about it. Don't even check the prices. Just wait and you will get your adequate return. These things are all psychological. That's why it's called behavioral finance. It's not even about skill necessarily. A lot of it just has to do with the psychology of being able to not freak out when your assets are varying in price and going up and down in value. Just because an asset is valuable, that doesn't mean it's worth an infinite price. So what that means is you can look at a company like Amazon, which is always in the news for its great growth and all the things it is doing. But just because Amazon might be an amazing company and might have great management and all these great things going for it, that doesn't mean that it's worth paying 300 times earnings or 400 times earnings for it. That means you might be taking a huge risk. Even though the company is great, the reason the price is so high is because the company is great. That doesn't make it a good investment. Same thing for a lot of companies, like for example, Tesla is a company that's very famous right now. They're producing electric cars. They've got a very charismatic leader named Elon Musk. Now, investing in Tesla, they've been losing money for a long time, or they make a very small profit some quarters, but their stock trades for a higher valuation than stalwarts like Ford and General Motors and others, despite the fact that they sell millions and millions of cars every year, and Tesla only sells a few thousand cars every year. The reason the stock price is so high is based on anticipation that their plans of rapid growth are going to be fulfilled, in which case people may end up making money off of that stock. But the thing is, it's very unpredictable. Therefore, it's very risky. I wouldn't want to buy that stock because there's a lot of downside potential. It could crash. I just don't know. But if you buy, like right now, for example, a company like GM, which is trading at only 6 times earnings and has a 4.5% dividend and has been selling cars for decades and has been profitable for decades, I'm not saying that that's a great company to buy, but just as a comparison between those two, GM is far less risky and you're almost certain to get an adequate return. Buying a company that has stable earnings, is only trading at 6 times this year's profits, and also has a 4% dividend. That will almost guarantee you an adequate return. And investing in that company or a company like that over 10, 20, or 30 years is going to guarantee that you will build wealth and eventually become financially independent. Okay? It's like what Charlie Munger said. Being conservative and not expecting miracles is the way to go. That's investing. If you like gambling, if you like speculating, if you want to try to hit a home run and buy the next new hot stock, I mean, just know that what you're doing is speculating, it is gambling, and you're more likely to lose money doing that than you are to make money. So at least know that that's what you're doing. There's nothing wrong with gambling if that's what you want to do with your money, right? It's your money. You can do it. You can try to make $1 million overnight, and some people do, but the odds are not in your favor. Okay? If you have no interest in or cannot do the latter, which is try to identify great companies to invest in, then you should simply invest in a low-cost index fund, long-term average return of 9%. I keep bringing this up because there's so much data and there are so many statistics that show that you will outperform, as hard as it is to believe, 90% of investment professionals by simply buying an index fund because of the low fees, mostly. A hedge fund or a mutual fund, they may sometimes actually beat the market over periods of time, but then they take their fees, and their fees oftentimes are 1 or 2%, even higher. They scrape those fees out, and your compounding gets hurt badly. It's the fees that really kill you. And so just by simply buying an index fund, not only are you not paying those fees, but there's nothing to think about. There's nothing to worry about. You just put the money in and wait. And one of the reasons why, and again, behavioral finance, this is psychology, people simply can't stand to do nothing and to wait. It's just too boring for them. They want to follow these companies and they want to be active and buy and sell, but that actually hurts you. Warren Buffett has said that in the stock market, money flows from the active to the passive. We should heed the words of the greatest investor in history, who has a 50 to 60 year record that has never been beaten. It will probably never be beaten. Some people say, well, other people, like for example, Peter Lynch, he has a higher compound return than Warren Buffett. But his investing record was only about 14 years or so during the 80s and 90s when stocks went through an unprecedented boom. And basically they went through a bubble. And so there are a few other investors that have gotten even higher returns than Warren Buffett, but nobody has done it for 50 or 60 years. Warren Buffett's 87, and his company's been going for like 50 years. Before he got his company, Berkshire Hathaway, he was making 40 and 50% compound returns. And so if he tells you that you will beat 90% of investment professionals for buying an index fund, we should believe that. He knows what he is talking about. Okay, and so the next thing we're going to look at, it goes back to something that I've been talking about throughout the course as well, to be investing in cash producing assets. So this idea to be greedy when others are fearful and fearful when others are greedy basically just means that when people are terrified and markets are crashing, that's actually the time when you should be buying because prices of stocks are going down. And the opposite is also true. At the before the dot-com bubble burst in the late 90s, that would have been the best time to be selling, getting rid of all your highly priced assets. But people had this big fear of missing out, which is actually another lesson we're going to look at, the fear of missing out. They didn't want to miss out on the gains that they could have gotten if the market kept going up. And so, it's this idea that everybody pretty much knows. Buy low and sell high. Only one thing that maybe a lot of people don't realize is that very, very few people actually do this. Most people don't do this because buying low when markets are nosediving, it's one of the hardest things to do psychologically, because as markets go down, we fear they're going to keep going down. When markets go up, we fear they're going to keep going up. And this is something that has to do with human psychology and also the nature of the way our brains work. We're constantly seeking patterns, and so we follow trends. If we see a trend going in one direction, our mind automatically postulates that it's going to keep going in that direction, even if that's not logical. So understanding that stocks and other investments, like real estate or whatever, they're more like groceries. You should buy them when prices go down, not up. But that's not what we do. Because of our emotional connection to money, we tend to do the opposite thing. The professional financial community has actually made investing very confusing. The way they talk about all different things, they make it very complicated, but it's actually very simple. Don't overpay for assets. You should be trying to find an asset that you can value, and you should be looking at the value that you calculate, which we're going to talk about more later, and then actually get real value for your money. It's not that complicated, but professional investors have made it complicated. They've made it seem confusing on purpose so that, of course, they can sell you advice and sell you products and things like that. In general, the best time to buy any asset, whether we're talking about real estate or stock market or whatever, is when markets are crashing. The best time to sell is when markets are in a bubble and prices are high. It's as simple as that, but it's not an easy thing to do. So Warren Buffett, he has said that you should have an IQ of at least 125 to manage your own investments. Otherwise, you should just invest in a low-cost index fund. So he's saying that, it does take a bit of intelligence, but an IQ of 125, that's like a little bit above average. It's not like you have to be a genius. But what he's also said, the next thing is even more important, that if you have too much above 125 IQ, it will actually hurt you, because intelligent people tend to overestimate their intelligence. So for example, a doctor or a lawyer who thinks they're very intelligent because they're an expert in one thing, they're going to naturally assume in many cases that they're also going to be good at investing, they're going to understand this other subject, when that's not the case at all. And so they end up being very bad at investing. And it turns out that people that are very intelligent but haven't been trained in this area, they tend to do the worst when it comes to investing their money. This is also a reason why doctors and lawyers and other professionals are targets for scam artists and con artists and stuff, because they have money, but then they're also overconfident, or at least they tend to be overconfident when approached by these types of scammers and stuff. So the lesson here is that investing is actually more about character than it is about intelligence. And that's a really, really important thing to understand when you manage your own money. It's that what you do and how you control your behavior is much more important than being super smart and understanding really complex financial instruments. Okay, and so with that, we're going to next take a look at how to outperform most professional money managers just by simply doing what Warren Buffett recommends, and a couple little tips here, and you actually statistically will be able to outperform 90% of money managers. People lost a lot of money at the end of the 1990s due to this tendency, this fear of missing out. They saw other people getting richer faster than them, and they worried that they were not getting rich as fast as other people, and they took ever greater risk. This is really crazy if you think about it, but it's a psychological thing that we tend to do. We don't want to see other people getting rich when we think that maybe we can be doing the same thing. We should never worry about someone else getting richer faster than us. There will always be someone that's getting richer faster than us. So it's a really crazy thing to work about if you really think about it rationally. And it's such a strong force that even, the experienced investor who's a billionaire, George Soros, who's very famous, he couldn't stand seeing others getting richer than him investing in tech companies, and he got killed, in the words of Charlie Munger. Now, this is someone who became a billionaire due to his investing prowess, and even he couldn't stand it. And Warren Buffett and Charlie Munger, they were getting criticized during the 1990s for missing out on all the money as they saw the tech stocks going up forever. It just seemed like it was never going to stop. And these guys were getting criticized. People said, they've lost their touch. They don't understand, investing anymore. They're old codgers, et cetera, et cetera. But what they understood was that it's not worth paying an infinite price for an asset when a company is not making any money, but they're just showing a lot of growth in users, but they're not actually making a profit. That asset is not worth very much. It's basic finance. It's basic valuation of businesses, but people didn't understand that. They just followed the market, and they all got killed. So, this fear of missing out is a really dangerous thing when it comes to money. Don't be worried about other people getting richer more. This is related to social proof, and it's related to keeping up with the Joneses, because it's comparing yourself to others. If you're happy getting a 7 or 8% or 9% return on your money, and that's going to help you achieve your investing goals and getting financially independent, then it doesn't matter if your neighbor made $1 million off of Bitcoin or off of that new IPO. It's totally irrelevant. Maybe they got lucky. They're probably just going to waste that money anyway. So this is something that we need to learn to not worry about. When markets are going up, there's this really, really strong psychological pressure to buy for the fear of missing out on more profit. It's a strong pressure, and it's very dangerous as the higher the prices get, because the higher the prices go, it's actually increasing the risk rather than lowering it, even though we feel like prices are going to keep going up, because as I said, we tend to look for patterns and we follow the trend. The higher the prices go, the riskier the investment is. And the lower the prices go, the lower the risk is. This is what we need to understand. This is why Warren Buffett, he looks at the intrinsic value of an asset when investing. He doesn't care about the stock price. He looks at the business and how much money it's producing, and he discounts their cash flows to the present. This is called the discounted cash flow model. I'm going to talk about it more later. But basically, you can actually value an asset like a business to within a very, very narrow range of values. And you can actually say this company is worth about this much. And then you look at the stock price and you go, wow, that stock price is showing that this company is worth way, way less. So this would be a really good time to buy because the actual intrinsic value, according to our estimations, is higher than the stock price. That means that we're getting more value than we're paying for. And the converse is true. When the asset is trading at a high valuation, and we look at the value of the company based on our analysis, and we go, there's no way the company's worth that much, it would be crazy to buy or to invest in the stock market when prices are higher. So we look at the intrinsic value of an asset. And remember Mr. Market. The market, the stock market or the real estate market, the prices that they are offering, that's not actually what the asset is worth. That's what the market right now is saying it's worth. Sometimes it's very accurate in terms of the intrinsic value. Sometimes it's way overpriced. That's why we have a bubble. And sometimes it's depressed when we have a recession or a depression. Okay, and the same thing goes for real estate or any asset that produces cash. If you have a rental property that you paid X amount of dollars for and it produces X amount of cash flow, that tells you what it's worth. If you paid $100,000 for a house and you rent it out at $600 per month, you're making around $7,000 or 7% cash flow on that asset. So you can value that asset based on the cash flows. Things that don't have cash flow are nearly impossible to value accurately, and you're just at the whim of the market. And this is why investing in the stock market and becoming a business analyst is the way to go. Or if you don't want to have to do it, again, just invest in a low-cost index fund. Sometimes prices are in line with intrinsic value, and other times they are far out of whack. I want to emphasize this because the market is just giving you quotes. And these huge swings in price, they will provide you with opportunities, or they will tell you to stay away. If prices are really low, you have opportunities to buy at good prices. If prices are really high, you should stay away. It's as simple as that. It's not any more complicated than that. It's just that it's simple, but it's not easy. It takes discipline, fortitude, patience, all of these things, and it takes ignoring the crowd. You have to be a contrarian and do the opposite of what the crowd is doing. That's why the whole phrase, be greedy when others are fearful and fearful when others are greedy, is such an apt phrase. It really describes the situation very accurately, but it's easier said than done. In the 1930s, it was one of the best times to buy stocks because people were fearful. The great crash had just happened. It was the Great Depression, and stocks were all trading at just totally depressed prices. And if you would have bought a bunch of stocks in the 1930s, if you had the cash, because most people didn't, that's one of the reasons why they were depressed, and you would have held them through World War II, through the 1940s, you would have become very, very wealthy. And if you would have bought a whole bunch of stocks in the 1990s, as prices just started going through the roof during the late 1990s, and then held them through the crash, you would have lost a lot of money. So you have to look at the prices of assets and decide whether or not the risk is high or risk is low. But having a fear of missing out when prices are going up is very, very dangerous. And then, of course, the next thing we want to look at is just good old-fashioned greed. This hurts people's financial decisions, and it doesn't have to. So let's look at that and see how we can avoid greed and why that tends to make people lose a lot of money. So the first thing is, if you don't really like investing or you don't have a ton of time to spend studying companies and investments and things like that, Warren Buffett recommends 90% of investors should simply invest in a low-cost index fund like the S&P 500. And I give you the ticker symbol in later lessons. It's SPY. That's one of them. Also, Vanguard has instruments like that. You pay low fees. It's passive. You don't do anything, but you will get average results. So you're going to pay lower fees and taxes. You're not going to be worrying about any decisions or really worrying about anything. as we know from statistics that over the long term, the average result of the market is around 9%. Now, if you compound your money at 9% over 20 or 30 years, you can get very, very wealthy. And we're going to look at some numbers later in the course as well. I'll give you some examples of how even as little as $500 a month saved up over time, compounding at 9%, can make you very rich depending on the time frame. So you're basically guaranteed to get average results. And as hard as it is for some people to believe, you're actually going to outperform most hedge fund managers and professionals who are constantly trying to outperform the market. They're getting paid huge sums of money to outperform the market, but they're also collecting a huge amount of fees, and their customers are incurring a lot of taxes because every time they sell an asset, they have to pay taxes on them. So simply by being passive, being more inactive, and leaving your money invested in an index fund, you're going to outperform most professional money managers. This is starting to become very well known now, as Warren Buffett is constantly out on the airwaves and talking about this, but it's a good thing for you to understand and for me to repeat. And basically, by not freaking out when the market is volatile and prices are going up and down, you end up outperforming most professional money managers that are really active, trying to outperform the market. Like I said, it's really difficult to predict what's going to happen in the market. Anyone who tells you that they can predict the market is either lying or they're fooling themselves. If someone like Warren Buffett and his partner Charlie Munger cannot predict the markets, these guys are geniuses. They've got 60 or 70 years because they're in their late 80s and 90s actually. They've got that much experience, and they say the market's unpredictable. We should listen to them. Basically, by being passive, you leave your money in the market and you let those companies that you've invested in earn money for you, and over time, the market will value that investment rationally. In the short term and the long term, prices will swing wildly, but over time, the market, as we say, it's a weighing machine. In the short term, it's a voting machine, but in the long term, it's a weighing machine. So the market is not totally efficient, but it's mostly efficient. So being passive rather than being active will make you more money over time. And there's this idea of Mr. Market. The market has a certain personality that is sometimes very irrational, and the prices are way lower than they should be, like after the Great Depression, and everyone was very afraid after that crash, so there was bargains. And then again, 1990s, you had this huge bubble when the internet was new and all these dot-com companies were new. Even though they weren't making any money, they were selling for astronomical prices because everyone thought this time it's different and growth will go on forever. Of course, we know that's not true. So the market can be very irrational, and this was an idea introduced by Benjamin Graham, who was Warren Buffett's mentor, and he was a very accomplished investor in his own right. He was a really good teacher of finance, and it's a way for ordinary people to understand how the stock market works. The market is not perfectly efficient like they teach in business school. The efficient market hypothesis teaches that the market takes all available information into account, and it's therefore efficient. But of course, if this were true, we would never have booms and busts. We would never have crashes. We would never have bubbles. So obviously, the market is not completely efficient. It has inefficiencies, and good investors can take advantage of these inefficiencies by buying when stocks are really cheap and selling when stocks are really high, or simply holding for a really long time and allowing the compounding to take care of itself. So in the next lesson, we're going to delve a little more deeply into understanding this Mr. Market concept and how it can help us as investors. Welcome to the course, Behavioral Finance, Why People Are Bad with Money, But You Don't Have to Be. This course is a follow-up to my first course on behavioral finance, the psychology of misjudgment. And I got a really good response from that class. People are really interested in this topic. It's a very interesting topic, and it's kind of a new area of finance that professors and researchers are really just starting to understand and go deeply into. And it's very useful for us to understand why people are bad with money and the common mistakes that we make when it comes to managing our money, saving, and of course, investing. Basically, behavioral finance is a new area of study. It came about by people like Charlie Munger and Warren Buffett getting extraordinary results in the stock market, and people looking at the results and wondering how is it that they're able to outperform other people in the stock market by so much. And a lot of the reason for their success wasn't because of a super high IQ, although they're obviously very intelligent. It was understanding certain psychological factors that tend to lead to bad investing decisions by most people and how we can avoid those mistakes. So it's really about avoiding mistakes and avoiding bad judgment more so than it is about being brilliant. And Warren Buffett and Charlie Munger are constantly talking about this when people ask them for investing advice and how to be successful in the stock market. A lot of it is just not making stupid mistakes and understanding how human psychology, due to the way we evolved in a different environment, actually hurts us when it comes to thinking about investing our money. We have a cognitive bias that is left over from earlier times in our evolution when certain behaviors were beneficial to us. But now these behaviors, they cause problems when it comes to making decisions in the modern world. And so by understanding these cognitive biases, we can make better financial decisions, we can avoid large financial and other types of mistakes in life and become wealthier and more successful. Most people don't understand these things, have never even heard of this before, and so this can be really beneficial for you if you are one of those people and this is all totally new to you, especially if you're someone who knows a bit about finance and investing. Looking at it from this angle and understanding the deep psychological nature of our relationship with money. It's very emotional, will help you a lot when it comes to making your decisions. So behavioral finance relates to all forms of decision making, not just finance. And so it makes it applicable to virtually every area of life outside the world of finance. And understanding these human tendencies can help us to avoid other problems like genocide, market crashes, destructive relationships, and just generally improve human life. So in this course, you're going to learn how to apply these tendencies to your life in order to be more healthy, wealthy, and wise, as Benjamin Franklin put it. But over the course of the next several lectures, we're going to learn why people tend to make bad financial decisions and what we can do about it. And in the next lesson, we're going to jump right in. We're going to look at how it's been psychologically proven that human beings tend to feel loss about twice as acutely as the goodness that we feel when we gain. And this has deep implications for how we handle money and how we save and invest. So that's what we're going to look at. So the idea of Mr. Market is that, every day you get an offer for your stocks to be bought at a certain price. Some days Mr. Market offers a fair price when the market's being pretty efficient. Other days he offers prices that are far too low or prices that are unreasonably high. Now, most people freak out about this because they think of the market as something that is telling you the actual value of your asset. And so if the price is going way down, we think we're losing money. But we're not losing money if we don't sell, right? If you hold stocks and the value goes down and you just hold them, and then later on the price that's being offered to you by Mr. Market goes back up and it continues to go back up, you haven't lost any money. But what most people do is they get afraid, they feel like they're losing money because the price quote from the market is low. They tend to sell their stocks because they're afraid of losing more money, and then of course they end up with a bad result. Where we need to be able to do the opposite. The same thing happens when prices go really high. Sometimes people will actually sell when the market is going up, when they should just hold on to their stocks, not even worry too much about the price quote from the market, and just let your money stay in there and compound. The volatility of the market is very psychologically difficult for human beings to handle. And this is why people like Warren Buffett and Charlie Munger and others who understand the nature of the market and have the discipline to basically ignore the daily price fluctuations are going to end up doing very, very well. And the whole idea here is to understand that it's the long term that matters, because when you invest in a stock, you're investing in an actual business, and the profits of that business are going to be weighed accurately over time. The market is going to fluctuate based on news, based on pessimism, based on maybe wars that are going on, and all kinds of external events. But over time, as we said, it's the market, it's a weighing machine. Over time, it will value your asset based on how much profits are produced. That's a key thing to understand. So that the daily fluctuations in price quotes that Mr. Market offers you are really irrelevant. That's something that is not taught in business school. But Benjamin Graham in the 1930s, he introduced this idea after having, a couple decades of experience himself with the market and actually suffering through the 1929 crash. He came to understand the nature of the market, and then for the rest of his days, it really helped him out. So basically, the market gives us a gift of having the choice to only buy when we want to. When prices are low, we can buy. When prices are high, we can sell. And otherwise, we can basically ignore what the market is telling us. Just don't pay that much attention to it. Now, that sounds like it's easier said than done, but it's a habit that can be cultivated. And of course, good investors, they do just that. So most of the time, we can simply ignore Mr. Market. As Warren Buffett himself says, he says you don't need to swing at every pitch. You can wait for low prices before buying an asset. This is a big advantage for us. If you're a baseball player, right, this is a baseball analogy, you only get a few pitches. If you swing at 3 pitches and you strike out, you're out. But in investing, you can just sit there and wait and wait and wait until a really good investment comes along. And then, of course, you have to have cash available. We call that dry powder in the business to take advantage of those low prices. And so we're going to look more at that throughout the course as well. According to Phil Fisher, who wrote a famous book called Common Stocks and Uncommon Profits, he's also someone that Munger and Buffett talk about a lot. Most people over fear losing value to inflation. So the reason I'm talking about this is because I just said that if you have cash ready to invest when the market goes down, then you can get really good prices and make a lot of money. But most people, they fear holding too much cash and not being fully invested because they worry about inflation. This is something that business gurus and teachers are always talking about. If you're not invested and your money's just sitting there in cash, you're losing 1 or 2% in value over time, because every year, if inflation is 2% on average per year and your cash is just sitting there under the mattress, for example, you are losing value. But the thing is, this is an over fear. We shouldn't invest our money in overpriced assets and then lose it, or have a high probability of losing it just because we worry about inflation. It's better to have a little bit of inflation go on and lose a little bit of value, 1 or 2% on your money over the course of 1 year or even 2 years, and then all of a sudden have a huge opportunity come your way and invest at very, very advantageous prices. So holding cash and waiting for low prices is better than always being fully invested, no matter how high the market is. That's why Warren Buffett and Charlie Munger, during the 1990 boom, when all the tech companies were going through the roof in price, they were just letting their cash pile up. And then when the crash happened, they started buying companies at discount prices. They did the same thing in 2008 and 2009. They were one of the few companies that had cash available to buy all of these extremely discounted assets. And so this is something that has to do, again, with patience and discipline. It's not rocket science. You don't need to be a genius to hold money and let it build up when prices of the market are high, but it does take discipline. So we're going to talk more about this because it's such an important concept that most people don't appreciate. You don't need to always be fully invested. Psychological studies show that social proof is a very, very powerful psychological tendency. When we see someone else with something of value, we automatically desire to have the same thing, or at least 99% of us tend to do that. Whether or not we realize it, we have a subconscious bias towards wanting what other people have. This makes sense from an evolutionary point of view. When we saw someone else with food and we wanted food, we need to figure out how can we get that food. We want what we see others have. In other words, our society itself, it creates a strong desire for us to consume, to spend our hard-earned money. And of course, this is going to hurt us if our goal is to save and invest money and become wealthy over time. We need to not be spending our money. We need to be investing our money. So keeping up with the Joneses and having this idea of social proof, it really hurts us. So we need to learn how to, first of all, not care what others think of you, what they think about your car or how nice your house is or how nice your clothes are. You need to learn to not let that bother you and learn to spend less money on those things. It's not necessary to have 10 jackets or 10 pairs of shoes or 10 pairs of pants, right? It's not necessary to have a $50,000 car, but a $10,000 car will do, etc. So we need to learn how to not care about the possessions or wealth of others. The funny thing is a lot of people spend more than they make on having a nice house, nice car, nice clothes, etc. That's why everybody's in debt up to their eyeballs. People use their credit cards and things like that. So we're looking at possessions that people may not even actually own. They may have gone into debt to buy, and it's ridiculous that that makes us feel bad by not having those same things. As Warren Buffett says, you need to learn to have an inner scorecard. Excuse me. Don't compare yourselves to others. In other words, you need to know who you are internally. You need to know what you want. You need to keep score of your life and how happy you are and how well you're doing in terms of accomplishing your goals and your dreams, regardless of what other people are doing. You should not be measuring yourself compared to other people. You need to have an inner scorecard. And if you can orient yourself that way over time, then this social proof tendency, this keeping up with the Joneses tendency will diminish, and you will start spending less money on unnecessary things, and you will start saving more money to invest. By understanding our social proof tendency, you can learn how to spend far less money. Most of us, if we're honest, we spend a large portion of our income on unnecessary items like that daily latte, that extra $5 here, that extra $10 there. That money really does add up. And if you know that it can be compounded and double every few years, if you're getting a good return on your investments, you will be able to control this tendency much more easily. In the words of Benjamin Franklin, a penny saved is a penny earned. Or even better, the way to look at it is that if every penny that you save can be invested and can earn you compound interest and make you wealthy. That's the way to think about it. So the social proof and keeping up with the Joneses tendency is a very, very strong one. But by reflecting on this and by thinking about it, and over time you can try to manage your behavior and don't care what other people have or what other people think about what you have. It will help you a lot if your goal is to become financially independent. And something that's related to this is this fear of missing out tendency, which I already mentioned earlier. Is another very, very powerful psychological force that we have that tends to lead to all kinds of bad financial behaviors. And I'm going to give you guys some good examples of this in the next lesson. Most people are simply not disciplined enough to forego pleasure now for the ability to afford far more pleasure in the future by investing their money instead of spending it. We overspend, especially us Americans. We are terribly guilty of doing this. We have lost this whole idea of delaying gratification. It works in exercise and dieting and health. It works in your career when you study and go to school for a long time, and then later on you reap the benefits of a high salary. And it works even more so in investing when you save money, you maybe sacrifice a little bit, but then you watch that money compound and compound and compound exponentially over time. So by simply developing the habit of being frugal and not spending money on unnecessary things, which a lot of our expenditures are, the average person can become financially independent within only a few short years. So lowering your expenditures, it does two different things. First, it makes you become used to spending less money, to living off less money. So if you don't need as much to live off of, you also will be able to reach financial independence more quickly. Instead of needing, a couple $1 million or whatever to be financially independent, maybe you need half that. Maybe you need less than half of that because you learn how to be frugal. And then, of course, by also being frugal, it creates that surplus that you need for investing, which will make you wealthier over time. So it's sort of a 1-2 punch, learning how to not spend money and then also learning how to invest your surplus. This is the way to handle your money intelligently, and it simply has to do with delayed gratification. By simply saving as little as $500 a month and investing that in a low-cost index fund, like I mentioned before, we can just say the S&P 500, the ticker symbol for one of the funds is SPY. You can look that one up on the internet. I use Yahoo Finance for most of my information needs. You would have $2.6 million after 40 years. Now, 40 years seems like a long time, but this is only investing $500 a month. And this is pretty much a guaranteed return. 9% is a long-term average return of the stock market over long periods of time. So just $500 a month and just waiting for a long time, you'd have $2.6 million. That's a lot of money. And if you go even only 30 years, you would have almost $1 million. This is starting from scratch with zero money, just starting to put away $500 a month. For 30 years, you'd almost be a millionaire after 30 years. Now, if you just increase that to $1,000 a month, you would have almost $2 million after 30 years and $5 million, over $5 million if you waited 40 years. So if you started saving $1,000 a month when you were 20, by the time you were 60, you would have $5 million. Now, that almost seems unbelievable because I don't know anyone who's done that. And you may not either. $5 million is a lot of money to make this way by simply saving and investing over time. But if you understand the power of compound interest and you understand this example that I'm showing you right here, you should start saving money right now. It doesn't take anything other than socking it away into an index fund and letting it compound. The problem is, and the reason most people don't do it, is because they don't want to have to wait for that future money. They can't delay their gratification, and they also can't stomach the gyrations of the market. Constantly seeing the prices go up and down, it can make somebody sick if they look at their hard-earned money go down by 10% over the course of a month or two, which sometimes happens during a correction, and they feel like they're losing money and then they sell. The best thing to do is simply just forget that you have money in there and just don't check it. Don't check the prices on a daily basis. That's what Warren Buffett says to do. So delayed gratification, understanding delayed gratification, and having discipline to forego pleasure now for pleasure in the future. This is at the heart of being good with money. And you simply have to find a way to do it. And one of the reasons that most of us can't do it or find it very difficult is because of social proof and keeping up with the Joneses. When you're surrounded by people who spend their money a certain way, who like to show off the things that they own to everyone around them, it's very, very difficult to resist the temptation to do the same. And we now live in a very materialistic society where this is a rampant problem. And so we're going to turn to this social proof tendency next. Basically, we have learned that we feel losses much more acutely as we feel things that we gain. So when you lose money gambling, there's this really strong urge to try to win it back. And when you do win it back and then you make a profit, you actually don't feel that good. You just don't feel bad anymore for having lost something. So this is very profound. It has deep implications for how we behave when it comes to money. So in other words, instead of chasing gains, we should seek to avoid losses, and that will lead to more peace of mind as we invest our money, and it will also obviously just naturally lead to more success. So instead of trying to make a lot of money and chasing returns in, let's say, the stock market or in real estate, by being conservative and trying to avoid losing money, we will probably end up doing very well. So as Charlie Munger has said, being conservative and not expecting miracles is the way to go. Very simple and a sort of a common sense approach, but it's what most people don't do. And so we have to look at some of this basic stuff and try to understand why is it that even though it's so easy to understand, most human beings don't actually behave this way. In order to achieve a certain outcome, it is often best to look at how to avoid the undesirable outcome. This is called inverting. This is something that mathematicians do. In order to solve a problem, it's often best to invert the problem and look at it backwards. And again, this is something that Charlie Munger is always talking about. If you want to be happy, maybe you should look at the things in life that make you unhappy. So he says that, that's because of that we can avoid drugs and alcohol, we can avoid addiction, we can avoid all these other bad behaviors, and simply by avoiding bad things, we're going to be left with what is good. So we can apply that same logic to how we handle investing and money. So an example would be, investing with a virtually guaranteed or high probability of an adequate return, like say 7%. That's much better than trying to take more risk and hoping for a larger return, like let's say 20%, trying to get rich faster, and then not only end up actually losing money because you pushed your money too hard, but then also feeling twice as bad about the loss, right? So when you're trying to make money too quickly and when you are not satisfied with an adequate result, one that actually over time will make you financially independent. If you look at compound interest tables, as we're going to do at one point later in the course, you'll see that investing money, even relatively small sums, at consistent 7% over many years will make you quite wealthy. But a lot of us, we want to make it faster, we're greedy, we make this mistake of trying to chase returns, and when the easiest thing to do would be simply to accept a lower return, a higher probability of that return, and basically get a guaranteed result, and at least avoid the pain of losing our money, because of course Money is very emotional. That's the whole point of understanding behavioral finance. We're realizing that human beings, we have this very deeply emotional connection to money, and it causes all kinds of bad behavior and bad decision making. Another thing that's important to understand is that, it takes a 2% gain in your assets, of appreciating your assets, to make up for a 1% loss, because, your assets, after they've lost 1%, they have shrunk from the original amount. So now, in order to gain that 1% that you lost, you've got to compound your money at a higher rate. Spelled higher wrong here. Let's fix that. Okay. And so it hurts to lose money, so let's try to avoid losing money in the first place. And if you avoid losing money, you don't need to compound your money at a higher rate. You can accept adequate results, and your capital will simply grow and grow over time. This is why Warren Buffett and his company Berkshire Hathaway, when you look at their investing results, sometimes during boom years, during big long streaks where they've actually underperformed the market, like in the 1990s during the dot-com era, they still end up with much, much higher compound return, because when the markets crash, they tend to outperform the market by huge amounts during the crashes, because they have so much cash on hand and because they didn't invest in all those risky assets, that by basically avoiding losses, they end up with a far, far superior long-term compound return. So it's a really important thing to understand that when you lose money, it takes a long time and a lot of effort and maybe more capital to get back what you've lost. But if you simply avoid losing money and invest conservatively, then you end up getting much, much richer over time. And that's why one of the things that Warren Buffett says is rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. Yet another very basic common sense thing to say and understand, and yet something that will help us if we actually act it out in the real world. Okay, in the next lecture, we're going to look at this whole idea of being greedy when others are fearful and fearful when others are greedy. It goes against our natural tendency to buy assets when their prices are low because we're afraid, and to sell assets when the prices are high because we want them to keep going higher, and it seems like they're going to forever going to go up. But this is actually the opposite of how we should be thinking and behaving. So we're going to look at the reasons for that in the next lesson. So it's really important to understand that you do not need to always be fully invested. Most people fear the stock market because they have all their money in there, and then when it inevitably crashes, as every once in a while it will do, it causes a lot of pain and suffering. There's no need to have all of your money in the market all the time. In fact, as the market goes up, as the prices go up, the intelligent investor should be buying fewer stocks and be letting cash accumulate, because you want to be buying at lower prices. This is the opposite of what most people do, because they fear that as stocks get more and more expensive, or real estate, or whatever asset we're talking about, that they're going to lose out on the opportunity to buy and to get back into the market. But as we know from history, prices will not rise indefinitely. There will be a crash, there will be a downturn, and as the market goes down, the intelligent investor should be buying more stocks at ever cheaper prices and let their cash reserves decrease. So this big fear that holding cash is going to be losing out because of inflation, it's a big over fear that is losing people a lot of money. Holding cash for 1 or 2 years is no big deal. It's much, much better to do that and not lose a whole bunch of your net worth than to be afraid of 1% loss or 2% loss due to inflation, and then buying when prices are high and then losing 30 or 40% of your assets when the market crashes. The intelligent investor will be buying when the market crashes, and they will have cash available, as we'll see in some examples later when Warren Buffett and Charlie Munger, how they behaved during the dot-com crash as well as the crash in 2008, 2009. They had a lot of dry powder, as we say, available, and they were in hog heaven. It was just buying all these assets at huge discount prices. So the fundamental skill needed for this behavior is patience and discipline. It is not a high IQ. By always keeping, say, 10 to 30% of your assets or so in cash, you can sleep well at night knowing that you're safe no matter what the market does. So always having a large cash reserve puts you in a position to take advantage of bargains when the markets do crash. So you're getting two benefits here. You are sleeping well at night knowing that you have a large portion of your assets out of the market. So if they crash, you're not losing money. But then while everyone else is losing money and has no cash to invest, then when the markets crash, you buy assets at a big discount. So your cash reserves should go up as prices go up and you buy less. And your cash reserves should go down as the market goes down and you buy more. This is the exact opposite of what most people do. It kind of goes against human psychology, but this is the way to be a successful investor in the long run. And this is where all the really big money has been made, as I said before. Warren Buffett says in order to shoot fast-moving elephants, you need to keep a loaded gun. He's alluding to this idea that you need to have money at the ready so that if an opportunity all of a sudden presents itself where maybe even an individual company's stock crashes because of bad news or some scandal and it goes to an irrationally low price, you can buy up those shares while they're cheap and then before they go back up. So you need to keep your money ready. You need to have a loaded gun, as he says. So an example of this was that during the 2008-2009 crash, Warren Buffett, he bought the entire Burlington Northern Santa Fe Railroad at a huge discount to what it had been selling for just a year or two before, and he tripled his money within just a couple of years, tripled his money. So imagine if you had $100,000 to invest, you've been saving up, and the market seemed expensive, all of a sudden there's a crash, and you see all these bargain stocks, or even real estate crash as well, and all of a sudden you could buy, two houses for the price of one. And so you go in there and you acquire these assets, and within a few short years, you've got triple the money that you had. Or imagine if you did that with $500,000 and you tripled your money. Well, you're financially independent within just a few years. This is the way it's done, and it doesn't take brain surgeon level intelligence. It does take this skill of being able to wait and to watch. Of course, if you're not interested in this and you don't know how to do it, you don't want to do it, then all you need to do is what Warren Buffett recommends, which is buy a low-cost index fund and let your money compound at 9%. It's also a good idea. Another example is what Charlie Munger did during the same crash in 2009. He put tens of millions of dollars that he happened to have lying around in one of his companies. I think it was the Daily Journal, which is a newspaper, a legal newspaper that they own in California. And he took all that cash and he bought, actually the very same day that the banks bottomed out in 2009, he realized that they were probably going to get TARP funds, get bailed out by the government, and they were trading at only 1 or 2 times earnings, which is just an unbelievably low price for a profit-producing asset, or at least these banks that almost for certain, once they emerged from the crisis, would be producing a lot of profits and growing again. It's a very, very, very cheap price. So he put tens of millions of dollars in these banks, and then he made 5 or 6 times his money within just a couple of years when everything went back to normal. And the reason they were able to do that is simply because they had cash available, whereas most people didn't have cash available. Also, due to the fact that almost everyone else was fully invested, they were desperate for cash. They were desperate for money. So Warren Buffett, he went around and he got all these amazing deals. He loaned money at amazing rates of return, and he just made a killing off of it. And it wasn't because he's a genius, although he is that. It's because he understands the nature of markets, and the best time to buy is when assets are depressed. And in order to do that, you have to have cash on hand. This is a really important lesson for us lay people to understand. We don't have to be rich like Warren Buffett to take advantage of this. If you had cash when the real estate bubble popped in 2008, you could get 2 or 3 houses for the price of one from previous prices from a year before. You could pay cash for houses after that bubble popped. But of course, most people were fully invested because they were worried about prices going up and up, and no one had money to invest. So this is a great lesson for us to learn. And the next thing we're going to turn our attention to is the power of delayed gratification. It seems to be a lost art. But by understanding how to apply delayed gratification to our expenditures and to money in general, we can basically guarantee ourselves financial independence within not that long of a time frame.